Whatever. I'm just asking. I'm just
Good afternoon. This is the last session which we are starting, and this is on transfer pricing, the base erosion and profit shifting project and beyond. We have a quite experienced panel with us. On my extreme left is Mr. Sanjay Kumar, a person who has been handling the international taxation during his postings in other various places, and he was Secretary Tax Reforms Tax Administration Reforms Commission. After that, he has left and joined Deloitte. Mr. Ashutosh Dixit, again another tax person, but a person who has worked extensively in the ministry in the area of foreign tax policy and been working on various tax committees, etc. And he is now again on the private sector side in BMR. Mr. Ashutosh, Akhilesh Ranjan has been Joint Secretary for Foreign Tax Division in the Ministry of Finance, and has been extensive right from the beginning. He has been involved with in this BAPS exercise and G20, and even today he is the Chief Commissioner in charge of international taxation. So we have people who have all international taxation background, of course, working at different places. Instead of a normal practice of presentation, we are just going to introduce the subject and the issues, and our panelists will like to react to those issues. See, it is like this base erosion and profit shifting has become an issue in recent times. Actually, what happened, the globalization has led to growth in international trade, but has also created issues of double taxation in income. This was mitigated by concluding double taxation avoidance agreements. Over the period, with this economy is becoming more integrated, MNEs have shifted production activities to other locations, from location of its customers to take advantage of skilled manpower, location advantages, etc. This has resulted in intercompany pricing as an everyday business necessity. The spread of internet and digital economy have further aggravated the situation, and MNEs have become aggressive in their tax planning as well. Multinationals continue to engage in activity which result in taxation at lower rate or even nil rate, resulting in loss of revenues to number of governments. And therefore, the transfer pricing continues to be a burning issue on multiple converging fronts. Initially, developing countries were affected more, but lately this has also started affecting developed countries of Europe as well. In 2013, OECD and G20 countries working together on an equal footing adopted a 15-point action plan to address the base erosion and profit shifting. This work was taken forward by OECD, G20 and host of developing countries with a total participation of nearly 85 countries, which finalized the recommendations. Recommendations on all the action points have been received and approved by the G20 countries. India has actively participated as a G20 member. Out of these 15 action points, in this session we intend to concentrate on action points 8 to 10, 13 and 14. First, we'll take up this action point 13, which deals with, which has bearing on and is an enabler for all other action points. Action point 13 provides guidance on transfer pricing documentation, country by country reporting, This is a three-tier reporting system where master file and local files are to be submitted to the tax administration of the country where MNEs are conducting their businesses, and country-by-country reporting will be filed in the country where the MNE is resident. The tax administration of the resident country will share country-by-country reporting data with the administration of other countries where MNEs are operating. This will be enabled through bilateral agreement, tax information exchange agreements, and other agreements. Data contained in the reporting made under Action Point 13 are expected to provide input for implementation of the recommendation related to all the action points, as well as help in identifying risk assessment cases. India has enacted the enabling legislation and is to be implemented with effect from 1st April 2017. 50 other countries have also taken steps to implement the reporting requirements. India has also signed the agreement for automatic exchange of information with effect from 1st September 2017. However, this throws up a few concerns, and I'd like to know from the panelists how the developing countries are going to address the challenge of implementation and sharing of information. The second question which we need to address, what are the concerns and apprehensions of businesses, particularly the multinational enterprises? And lastly, are the business and Indian tax administration ready to implement the recommendation, whether technological infrastructure is in place with the tax administration to tackle this issue? So to begin with, I'll ask Mr. Sanjay Kumar to react to these issues.
Thank you very much. BEPS, of course, came in, was announced all the action points sometime in November 2015. Based on it talks about the three pillars: coherence, substance, and transparency. Action 13, which Mr. Singh referred to, is basically about the transparency. How what is the structure? What are the transactions? All have to be shared within with the tax administration, not only in the host country or the source country, but also wherever the structures exist. So in a way, the information is available for the countries to tap on that and thereby build on their whole risk assessment system, by which they can point out, based on the information or other set of information which you get from the CBC or other information, what are the risk issues, and then the audit, etc., can be there for the examination of the entities and the transactions. Having said that, the challenge, as rightly pointed out by Mr. Singh, is that information is certainly there, but most of the developing countries, and particularly I was talking to some of the tax officials from the African countries, they do not have even a very moderate transfer pricing system. So even if you have the information and internationally it is available, and they do not have the skill to tap that, then the issue of the capacity the capacity building becomes the foremost here. They also do not have the comparables. They have not done the transfer pricing. They do not have comparables, or they do not have sufficient number of the industry's system by which they can have a domestic comparison. India is rather fortunate, because when the transfer pricing got introduced in 2001, over the last 15, 16 years, it has gone up the curve in a very, very significant manner. Of course, there have been a lot of issues on the amount of adjustments, but the silver lining out of all those adjustments has been that the tax department did learn a lot on the transfer pricing, and they became at the forefront. And some of the BEPS recommendations which have come, does say something which the Indian tax authorities were implementing or believing that it should have happened, although the courts were very strict and that did not happen. I would not lead to that debate, because that's a very, very different one. But Having said that, the basic issue comes, therefore, is that where is the capacity? And on that, the G20 countries and other countries also need to start thinking about it. BEPS is very important, and my sense is that the developing countries, if they implement it properly, their revenue are going to go up. Because what it talks about is if there is some economic activity taking place in a particular location, call it a developing country, then the profit attribution, to the extent that it is happening in that country, has to be remunerated in that manner. So that commensuration, if while in principle everybody has agreed, but to implement that, you need to have a good skill sets. You also need to know, how do I tap the information? While agreements are being signed, every day we keep saying such and such country brings the Action 13 in its legislation, brings out the CBC and master file requirement in their legislation. That's very good, but unless skills are there to tap that, will be different. So we'll take up that particular issue, and then later on we can talk about something else as in the turn comes.
Yes.
Thank you, Sanjay. So, just stepping back a bit to add to the background of BEPS, which Mr. Singh and Sanjay spoke about. Where did the BEPS concern emanate from? After the financial crisis, even prior to the financial crisis, the trend in tax collections globally has been that tax rates on companies have been going down. Essentially because there was an element of competition there, and if you look at it over the more than a decade, those tax rates have been coming down. Now, therefore, where do you get those resources from? Those resources are essentially now being generated from indirect taxes in the form of GST. They are the major components of the tax collections, or a higher personal income tax base, which the developed countries can rely on, but definitely which developing countries cannot, because we have very low personal income tax bases, primarily due to the incomes themselves. Now, given this environment where corporate tax rates themselves are going down, it was the concern of all the countries, irrespective of whether you were developed or developing, that the last paisa of the taxes due from corporate should be collected. Especially in an environment where the taxes are actually, overall tax rates are going down. This got exacerbated with the financial crisis, because countries, even the developed countries, realized that they needed much more resources to meet their liabilities, especially the pension liabilities and so much and so forth. And therefore, there was this common, purpose that how do we create more, get more revenues from corporates. Given this, almost 80% of international trade is now between branches of multinational enterprises. And therefore, the major contributor to corporate taxes are multinational enterprises. And over the last decade or so, the two trends in globalization international trade have been, the number one is the integrated value chain, which is that it is no longer a simple thing that, a multinational enterprise is getting items manufactured at one place and then exporting it to the other. Now you have different components being manufactured in different jurisdictions. So you may have export of something where there's slight value added, and then the re-export of that from the other jurisdiction to a third one where another value add has happened. And therefore it is now extremely difficult, although transfer pricing, which is essentially what? It is that, you allocate the right prices to transactions so that the income, gets taxed in that jurisdiction where that particular value has got created. Transfer pricing itself has become much, much more complex. The arm's length principle has been accepted internationally. It's part of the tax treaties, Article 9. But with this kind of thing, the complexities of tax treaties went up substantially. the opportunities for multinational enterprises to park their profits in another jurisdiction, and that is what you call offshore, investment hubs, where you would want to park your capital and then reallocate it based on your business needs. These are legitimate business needs. The only thing is that part of it, that is also the fact that you want to be the most tax efficient. So these are the two, developments, or the three developments over more than a decade, which then raised these BEPS concerns. Now, when the BEPS concerns came, and as Mr. Singh pointed out, there were 15 action points. If you look at them there, you can look at them in three buckets. One bucket is that the tax treaties themselves. So from this 30s, 40s onwards, there has been this double bilateral tax treaties between countries in which the countries agree that, enterprises working across in both countries will not be doubly taxed. And there are there's a whole network of treaties. Every country has, for example, India has 90 plus treaties, and so many other countries do. Now, because the fact that it became so difficult to allocate the right profits in different jurisdictions, and because this was never done in a systematic manner, M&E tax planning actually involved using tax treaties, favorable tax treaties, for reducing tax liability. So that is one bucket. BEPS has tried to address that through through some of the action points with regard to the amendment of tax treaties themselves and bringing them onto a common kind of a platform and anti-abuse provisions there. The second bucket is actually the mismatch between tax treaties and domestic legislation. So those mismatches were again being used, to reduce tax liabilities, and countries had those concerns. That is the second bucket, which will also gets addressed in certain action points. The third is the transfer pricing bucket, which Mr. Singh just mentioned, is actions 8 to 10, and then what we say action 13, which is the interchange of information. Now, in the transfer pricing regime, when we're talking about currently Article 13, which is more about information, how do I allocate the right arm's length price to a transaction in my jurisdiction if I don't have a holistic picture of what has been the background to that transaction in other jurisdictions. So there is a great information asymmetry. Now, prior to the BEPS initiative and the G20 OECD initiative under the BEPS, there were bilateral tax treaties, but there was information sharing, but it was quite piecemeal and quite ad hoc. Under this country-by-country reporting mechanism, what has been decided is a common template that the M&E will file in its own headquarters, and which will then get shared by the headquarter country with other countries wherever that M&E has operations through subsidiaries or other kinds of business arrangements. This CBCR, therefore, is a great step forward through the BEPS initiative, because now countries, irrespective of whether they have developed, developing, and whatever stage they are, they will get access to this country-by-country report, which will give them more information with regard to how to properly price the arm's length transaction in their own jurisdiction. The concerns and the 3 points which Mr. Singh spoke about was, developing country concerns. The developing country concerns are, number one, is that actually transfer pricing itself is a very, very fact-intensive exercise. It is something where it is not just a science, it's between an art and a science. It's not very amenable to a lot of, what I would say is dispute resolution, because every transaction is becomes very fact sensitive in itself. So while in the developed countries, the OECD has come out with a lot of transfer pricing guidelines, in the developing countries, transfer pricing is a relatively new phenomena, and given the resources which developing countries have, it's difficult for them to allocate those resources just to transfer pricing when they have so many other challenges on the tax front. India, as was mentioned, has been fortunate. We introduced this in 2001, and the jurisprudence has developed a lot, and actually a lot of the issues with a lot of the concerns which were raised in BEPS and which are being addressed through the amendment of these guidelines have been raised by India. But yes, the developing country concern in varying degrees is that even if I have a country-by-country reporting mechanism, first of all, I have to have a mechanism to receive that information, because it's going to be electronically received. Once I received that mechanism, there is a multinational business concern. Their concern was that this kind of information which is being received should not be shared with all and sundry, even within your tax administration. It should only be on a need-to-know basis. It should be used for risk assessment about deciding which particular cases to audit. So a second challenge in developing countries would be is that even once you receive this information, how do you actually use it to make a risk assessment? And also that it gets disseminated only to the right persons. So that is the second challenge, which then is the challenge which is that what the businesses have. I mean their concerns. And the third is the readiness themselves, which I have already addressed. Most countries are introducing CBCR legislation in the current year, so has India. India specifically, we don't face these challenges because we have built up a very robust systems, a tax systems mechanism again over the last more than a decade or so. And therefore, the challenges which I am mentioning are, I think, a lot to do with the developing countries based out of Africa. The silver lining is that a lot of the transfer pricing issues which come out of African countries are not to that degree of complexity because a lot of them are still commodity exporters. So they may still, have right now in their development, curve, they may have an option to pick and choose some of these, BEPS outcomes in transfer pricing and utilize them usefully for their own transfer pricing concerns. Thank you.
I'd like Mr. Achilles to respond to basically the concerns of MNEs and the preparedness of Indian tax administration.
Yes, thank you. Thank you, sir, and thanks, Ashutosh and Sanjay. Well, I think the background of this transfer pricing documentation and the country-by-country reports has already been explained and talked about here. I would just like to give another perspective to the context in which we should be discussing this. I was looking at the agenda for this seminar and I find that this is the only tax-related topic in the midst of discussions on energy, climate, many lofty subjects out there. But then I think it's extremely relevant to have this sort of a subject in such a seminar when you're talking about the G20 effort. I would bring it to your notice. In fact, we have been seeing from communiques and statements and declarations of the G20, there may be a lot of discussion on macroeconomic fundamentals or theory or climate or whatever. But the only progress made in G20 till date is on tax. There is no other progress made by the G20 anywhere. And this progress has been astounding, absolutely. Something which was not expected and not hoped for. Suddenly, countries around the world globally have agreed, have come to a consensus on issues because of a common concern raised through the G20. So right from the beginning of the G20 initiative, I think there was a call for preventing base erosion, on maintaining tax bases. The OECD was asked to work on that, and you have just heard about the 15-point action plan called BEPS. There was need for transparency because which was exemplified by the US coming out with a law called FATCA, which required financial institutions to automatically report information to the US IRS. The European countries, the EU, others, etc., then decided that must have a global standard for automatic exchange of information. And once again, the G20 seized upon this initiative and said, yes, we strongly endorse this. So the two major tax movements going around in the world today are both, in a way, G20 initiatives, and these are the success story of the G20 at all. Hence, I think a discussion on tax and on this and what it has brought about and what it means for G20 countries is something very important for anyone who is talking about the G20 matters. This country-by-country report in that context is a consensus amongst nations that multinational enterprises may be resident of any country, but they will report financial information on their own, and this information will be made available to countries around the world, wherever these multinationals are operating. And that's something which was not heard of earlier. No, nobody even envisaged such a thing. The fact that countries were able to agree to a certain amount of information was itself a major achievement of this project. If you see the nature of information that is to be now disclosed, let me say, by the multinational enterprise, it has, that master file is supposed to have a whole range of details of what is the organizational structure, what are the intangibles owned, where are the intangibles located, what is the intangibles policy, what are the financial transactions, arrangements, what are the service arrangements, what are the cost sharing arrangements. All that is supposed to be there in that master file. The country-by-country report itself comes out with figures of how much profits are being declared in different jurisdictions of the world, how much tax is being paid in different jurisdictions, what is the employee base and what is the asset base in those countries. So it's a huge amount of information, and understandably, multinationals and business is terribly concerned about this whole idea of transparency. So, but then if we view it in that context of where the world is moving, what the needs of countries, especially developing countries, these needs which have been recognized by the G20, then I think this movement towards increased transparency is an irreversible movement. It's something which has to go on. It will keep on increasing. And therefore, there is now no question of a debate on whether we should have this or not. The debate has to be on how best to comply and how best to go along with this movement of increased transparency. To the specific, yes, Mr. Singh has raised this point, how does India react to it? Well, India has a fairly mature transfer pricing system already in existence. There is a law, there are rules, there is an administrative structure. And for us, the handicap has always been a lack of information, because we have, till now, India has been sort of been the place where subsidiaries are located rather than the other way around. Now it is, of course, moving in the other direction. Indian multinationals are also moving out. But the major issue has been for us till now is whether the foreign-based, overseas multinationals, through their subsidiaries in India, are paying the right taxes in India. And for that, we needed information about the multinational group as a whole, information that was never available. This is what we will be getting from this new documentation rules, and it's something which will be of great help to our transfer pricing people. And apart from the fact that, of course, that it will lead to more transparency on the part of business, the BEPS project complements that by bringing in transparency on the part of tax administrations also. There is another Action 5 of the BEPS project which talks about harmful tax practices, which requires a review of countries if they have any preferential tax regimes. It requires countries to report automatically on any favorable tax rulings that they've given for certain types of taxpayers, which could be viewed as harmful tax practice or tax competition. So the onus or the burden is not just on business, the burden is on governments and on administrations also. And that's what I meant when I said that this movement towards transparency is something which no one can really stop now. It's something that even governments must realize, and we must get ready ourselves to be more transparent in our functioning and build systems which are rational and objective and which can deal with this increased transparency in a proper manner. So we welcome this new documentation rules. We have to, first of all, put in place systems or units which can analyze this information. We respect the concerns of the taxpayers that such information should not really be thrown out into the public. It should not be very public to all. Although it's not something that really is not in the nature of trade secrets or something, but then it is something which a multinational has over the years put into place as an organizational structure, and therefore they would be concerned if this goes out to any other enterprise. So we have to keep that in mind, and we are quite sure of how we're going to do it. There has to be an infrastructure built in that where the information comes into a certain place, it is used and analyzed by a certain set of people, and then it is disseminated to a limited extent to a certain specified set of tax officers. And that's the broad area on which we are working. We will, I think the government will be, it will take a little time, but maybe a few months down the line, we should have a system in India where we can have this information be properly utilized and analyzed. More important, of course, than having analyzed information from the point of view of risk assessment, then what do we do with that information? That is something we need a certain amount of capacity building in our manpower resources. It needs enhancement of technology in various respects, and how we can handle the information and process it in a way that is more objective. These are all challenges that India is facing at the moment, but we are quite confident that given the base that we already have a very sound technological base. We already have things, for example, we have a directorate of risk assessment already existing. We only have to build upon that. So I'm quite optimistic that in a few months' time, before the end of this year, we should be able to have specific and concrete systems in place which could inspire confidence in the minds of taxpayers. So I think as far as there should not really be any concerns remaining after that. We are going to use this information in the manner in which it is supposed to be used, and in the manner in which countries have agreed that it will be used. So there is no issue of India taking any different path on